Hi there. Thank you very much for stopping by. In this video I'm going to show you how I made 35 pips profit in the US dollar against the Swiss franc in the 5-minute chart. I will give you a comprehensive high-resolution analysis of the market. By the end of this video, you will understand the following professional trading techniques. First, I will teach you how to read, interpret and understand the poetry of price action from pure price candlesticks. Secondly, I will teach you how to correctly identify demand and supply structures in the market. Third, I will show you how to detect market manipulation and avoid getting outmaneuvered by banks and other large trading institutions. Fourth, I will teach you how market liquidity affects the majority of retail traders. I'll also show you how market liquidity affects the trend of the market. Fifth, I will teach you some applications of econophysics to pure price action analysis, and the uses of a pitchfork. Last but not least, we are going to look at the relationship between price action and its momentum analysis. I will teach you how to trade at the edges of the market, with tight stop-loss orders and large take-profit targets. Please stick with me till the end, and consider clicking the like button, and subscribing to the channel to learn more about professional trading lessons. Welcome. As usual, I start my analysis by counting and labeling the major and most significant vectors on the major flow of the market. Observe that I have marked and numbered vectors 0, 1, 2, 3, 4, to 5. Now let's begin with the actual market analysis so we can understand how buyers and sellers of this market are interacting with each other. At vector 0, buyers of the market exhausted their accumulated energy. This means that sellers of the market immediately took control of the market and started their exhaustion process as buyers get to accumulation mode. At vector 1, sellers from vector 0 met a powerful pack of buyers, or in other words, at vector 1 buyers had accumulated enough energy to drive prices higher once again. Vector 0 to vector 1 isn't so special. This vector can be classified as a major pullback by sellers of the market. Buyers from vector 1 drove the price up with relatively higher volatility compared to sellers' volatility from vector 0 down to vector 1. These buyers from vector 1 successfully managed to break through high 0 without much opposition from sellers of the market and created a new higher high at vector 2. This renders vector 1 as a solid and confirmed demand structure of the market. This means that at vector 1, we can expect a significant reaction by buyers of the major flow of the market in the near future of price if and when the price gets there. Let's analyze the activities of buyers and sellers of the market between vector 1 and vector 2. Observe that the first 3 bullish candles have solid bodies and very tiny tails. This gives us the level of certainty of buyers from vector 1. For the next 2 candles, we have sellers of the markets attempting to bring the price down but failed epically. The third candle is a bullish fractal candle as well as a long-legged doji. This candle has the following qualities. First, the candle has a tiny bullish body, a longer lower tail, and a relatively smaller upper tail. This gives the interpretation that at some point during the candle formation process, sellers attempted to continue driving the price down, but at some point afterward, a stronger pack of buyers overpowered these sellers and brought the price up, but sellers were not willing to surrender easily. The struggle between buyers and sellers in this candle made it close with a very tiny bullish body. This explains why I classified this candle as a long-legged doji. But eventually, buyers won the battle and continued to drive prices up. Around high 0, we can observe a little bit of sellers' reaction attempting to stop buyers from vector 1, but as you can see buyers won the battle once again and successfully created a new higher high at vector 2. This means that buyers from vector 1 are strong enough to progressively create new higher highs on the major dimension of the market. This renders vector 1 as the origin of this powerful pack of buyers. In other words, at vector 1 there is a lot of demand and little supply in the market. Thus, at vector 1 we have our first demand zone on the major scale of the market. Observe that I have drawn a blue horizontal line from vector 1. This line comes out of the opening price of the first bullish candle. This line is called the ignition point line based on the characteristics and price volatility afterward. I chose to name this line as confirmed buyers because these lines usually represent demand and supply on both major and minor dimensions of the market. From vector 2 onwards, our market analysis starts to get more subtle and more detailed. Observe that the first bearish candle immediately after candle 2 opened with a medium-sized gap down. And also observe that buyers were not able to close this gap down. This is our first impression that sellers of the market are strong enough to drive the price down with quite a significant volatility. Let's first look at the characteristics of this first bearish candle immediately next to bullish candle 2. First, this candle is the widest in the chart from vector 0 through to vector 2. Second, this candle has a large bearish body and tiny tails on both ends. Third, the candle has the highest volatility compared to all candles both bullish and bearish from vector 0 through to vector 2. The interpretation we get from all these observations is as follows. 1. This price behavior confirms that buyers have completed their exhaustion process. 2. Sellers of the market have accumulated a lot of energy as buyers from vector 1 were exhausting their energy to create vector 2. In simple words, buyers are weak at vector 2, while sellers are quite stronger at this vector. Moving a few candlesticks forward, we find 2 consecutive and massive bullish candlesticks. Let's observe the characteristics and the interpretation we get from these 2 consecutive bullish candles. The first candle has a solid large bullish body with tiny tails on both ends. The second candle has a relatively large bullish body, and a longer upper tail that successfully managed to pierce through high 2, but didn't close above high 2. Now let's unfold the chain of causality of these 2 consecutive highly volatile bullish candlesticks. Both candles combined have the highest volatility so far from vector 0 till now. Secondly, the second bullish bar pierced through vector 2 with quite a good range, but closed below vector 2 again with quite a good range as you can see from the chart. The interpretation I get from this unique price behavior is as follows. 1. The volatility of price in these 2 consecutive bullish candles represents the bait from the market makers. This bait is meant to trap retail traders who trade with this famous, simple, and misguided trading strategy called breakout trading. Market makers include banks, large trading institutions, and individual traders with enough capital to manipulate and tilt the markets. This group of traders usually trade massive positions in the markets, unlike retail traders like me and you. To trade massive positions in the market will cause a lot of distortion to the equilibrium of price in the market. Market makers understand this, and they have a strategy to trade around this barrier. This strategy involves making the majority of retail traders part of market liquidity. By this, I don't mean that banks and other large trading institutions can see or change retail traders' orders. No, that will be illegal and unethical. I mean that market makers employ some psychological traps that affect all humans, traders are not including the market makers themselves. This is legal and ethical. The details of how market makers employ psychological traps to outmaneuver retail traders are a lot for me to cover in this single short YouTube video. But I will create a free course here on my YouTube channel, so please subscribe and enable the notification button so don't miss out. Anyways, to make the long story short, the high volatility of these 2 consecutive bullish candlesticks generated what we called von Riestoff effect in the psychology of uneducated retail traders. In simple terms, the volatility of these 2 consecutive bullish candlesticks attracts more attention from all traders. This means that a lot of breakout traders place buy limit orders at the break of high 2. This generated a huge cluster of buy orders around vector 2, which is actually what the market makers needed to complete their market manipulation attempt. Once price triggered this cluster of buy orders around vector 2, the price equilibrium was distorted. This means that the market demand exceeds the market supply by a lot. The market cannot function under this condition, which creates an opportunity for market makers to sneak massive sell orders into the market. This is because market makers are the only ones with enough capital to bring the price equilibrium back to normal. This explains why the second bullish candle has a longer upper tail and is close below vector 2. Now let's look at the first bearish candle immediately after the second bullish candle closed. The candle is very large, has a large bearish body, a long lower tail, and no upper tail at all. This candle confirms the occurrence of market manipulation at the previous bullish candle right before it. Once this candle closed, all the breakout traders that bought the market at the break of high 2 were stopped out. When this happened, confusion occurred in the psychology of all these stopped-out breakout traders, and now they all realized that they were wrong about the price direction. This is the second dimension of market manipulation that we called reverse psychology. Now almost all these stopped-out traders are looking to take revenge on the market, by selling the market. This is what market makers were aiming for, to help drive their massive sell positions further into profit territory. And this is the final dimension of market manipulation that we call the bandwagon effect, or in simple terms the massive psychology. Note that I drew a blue horizontal line from vector 2 and I labeled this line as a deep liquidity pool. I drew this line to represent the level where market manipulation was successfully carried out by large traders. Also, this line represents the level where market flow or trend changed direction, as we will see in a little while. Let me just point out that market flow and market trend are the same things. I just prefer to use the word flow instead of a trend. After the market manipulation was completed successfully, the price started to fall in both minor and major flows. This is proven by the progressive creation of major and minor lower lows and lower highs, as you can observe from the chart. I want to bring your attention to how the price dropped towards the major demand structure that we marked at vector 1. Sellers' volatility seemed to be increasing as prices near the confirmed buyer's line. This is proven by the bearish candle bodies and range that they covered in the highlighted portion of the chart. Once the price was very close to the confirmed buyer's line, buyers attempted to bring the price back up by generating a solid bullish candle, with a large bullish body and only a tiny lower tail. But sellers were still powerful and immediately afterward continued to drive the price lower with higher volatility and successfully managed to zoom out the demand line of buyers from vector 1. After zooming out the confirmed buyer structure, sellers created a new lower low at vector 3 on the major scale of the market. This renders vector 2 as our new supply structure on the major dimension of the market. This also confirms the major flow shift that we detected at the manipulation level a few candles after vector 2. This means that the market is on a downtrend on the major scale and we should be aiming to sell and only sell at optimum trade locations. At vector 3, sellers were exhausted and buyers took control of the market and brought the price up to vector 4 with quite a higher volatility. The interesting thing is that vector 3 to vector 4 is made by only 3 massively large bullish candles. Other than that, vector 3 to vector 4 is just a major pullback by buyers of the market. Immediately after candle 4, the next candle, which is a small bearish candle, opened up with a small gap down. Buyers attempted to close this gap down but failed, as proven by the upper tail of this small bearish candle. This candle is an inside bearish candle pattern. This is because the entire range of this candle is completely covered by candle 4. Inside bars like this usually represent a momentary stop in price. This inside bearish candle signaled the origin of the next major leg of sellers of the market. Note that sellers from vector 4 successfully managed to break through low 3 and created a new lower low at vector 5. This renders vector 4 as our most recent supply structure still on the major dimension of the market. This is the zone where we can expect a stronger pack of sellers to show up again in the near future of price, as long as the emerging contextual elements support this hypothesis. Now at this point in my analysis, I decided to draw the black pitchfork that you can see on the chart. This fork is grounded on the following logically justified pivot points. The initial pivot is placed at vector 1. This is because vector 1 is the last origin of major buyers of the market. The lower limit is placed at vector 5. This is because vector 5 is our most recent lower low on the major flow of the market. The upper limit is placed at vector 2. This is because vector 2 is the last legit vector before the market was manipulated. The major purpose of this pitchfork is to establish a level where retracing buyers from vector 5 will run out of energy and strong sellers from vector 4 will trade control once again in the near future of the price. By using the middle median line, buyers made quite a volatile pullback from vector 5. But around the middle of vector 4 to vector 5, these retracing buyers seem to have hit a barrier, and price volatility suddenly dropped. Now we have arrived at the level where I usually collect and organize all my contextual elements. 1. We have a successful market manipulation occurring around vector 2. 2. This market manipulation caused a major flow shift in the market. This means that the market trend changed from uptrend to downtrend immediately after the market manipulation was completed. 3. We have a new and fresh downtrend on both major and minor flows of the market from Vector 2 onwards. 4. We have a Hagopian rule happening from Vector 5. This is because the price failed to reach the middle median line. Hagopian's rule states that if the price fails to reach any of the pitchfork lines, the price will reverse to the opposite direction with maximum volatility. 5. The final and solidifying evidence is the appearance of a solid bearish fractal candle, which is also an outside candle covering the entire range of the previous bearish candle. I triggered my short trade immediately after the bearish fractal candle close. I placed my stop-loss order a few pips above the upper tail of the bearish fractal candle, with the assumption that if sellers are still strong enough, then my stop-loss order is protected from buyers of market noise. My stop-loss order is approximately 7 pips and my take-profit target is 35 pips. Note that if I'm correct in my market logic, I will earn 5% more money in my equity curve. And if I'm wrong, I will lose only 1% of my capital. Let's see how the market developed afterward.
They call us gamblers. They say we depend on luck. They claim that no one can beat the market, and we're wasting our time. This isn't a real job. We should give up our hobby, they say. But if they only knew that we are the masters of risk, the essence of entrepreneurial spirit, the liquidity of the economy. We live by our wits, eating what we hunt, adapting to the ever-changing jungle landscape that is the market. We trade the currency you circulate when you shop. We trade the companies you work for each day. We trade the gold on the watch on your wrist. While you wilt at the sight of failure and loss, we relish adversity. We are not afraid to take losses, to talk about our losses, to rebound from our losses. Those are our defining moments. Discipline and self-awareness are our companions. We are what you've always wished you could be. And we're coming out of the shadows. We are traders.
After several minutes, my take-profit target was triggered successfully. There is a couple of things that I want you to note in this trade. First, note how the price missed my take-profit target and then came back near my entry level with maximum volatility. Secondly, note how the price missed my entry price and then dropped towards my take-profit target with relatively higher volatility and then successfully triggered my target. Third, note how the Hagopian rule was respected. Fourth, note that I did not change my trade position even after the price went against my trade order. This is how strong my trading psychology is. Closing the trade orders with very little profit means that you are suffering from the hyperbolic discounting effect. This effect seems good in the short term but deadly in the long term. Lastly, remember that breakout trading is very dangerous. Thank you for watching and I hope to see you in my next videos.